Let me start by saying insurance fraud is widespread and is a focus for insurance companies because of its impact, or its direct impact, on their bottom line, and at times, existence as a going concern. In the coming months, there's going to be an avalanche of insurance claims, and a chunk of them will have some degree of fraud baked into their claim. But there's something you need to know. Insurers are continually working to uncover fraud through a variety of low and high-tech techniques, including employing artificial intelligence. Submitting a fraudulent claim could result in significant fines, loss of future insurability, or a denial of the total claim, even the legitimate part. In this video, I'm going to show you ways that insurers identify fraudulent claims. If you are about to make an insurance claim, concerned about the one you may have just submitted, or have already been denied a claim that you submitted, this video is a must-watch for you. What you learn here, you will be able to use straight away. So let's go. So let's talk about the ways in which insurance companies identify fraudulent claims. First of all, they analyze claim history. If you have multiple claims for losses, that's an immediate red flag. And if you've claimed in the past, and worse, a claim where fraud was suspected or identified, your new claims are always going to be under scrutiny. When it comes to homeowners and auto insurance, one of the most prevalent fraud schemes by average people, not the pros or the fraudsters, is to report their vehicle as missing. You may not realize it, but insurance companies keep in-depth records of claims and perform an array of analysis to interpret collected data. Using artificial intelligence technology, they can determine who is most likely to file a claim, to when and where the accident will occur. If your claim does not match the typical pattern, they'll notice. Did you know that the National Insurance Crime Bureau, or the NICB, developed a list of 23 suspicious loss indicators? There are items within a claim or its circumstances that signal the claim may be fraudulent. Now, this list isn't super secret, but a lot of people submitting fraudulent claims don't realize that it exists and that it may lead to their downfall. So here are just a few of the suspicious loss indicators insurance agents look out for. If you have submitted a claim and are totally calm and unflustered after submitting it, and it was a large claim, that's a red flag. A claimant who submits handwritten receipts for repairs on a covered item sends off bells and whistles. A claimant who adds or increases homeowners insurance coverage shortly before submitting a claim, another red flag. A fire damage claim for a home or auto where the fire started immediately after a family argument or shortly after family members left the home. A medical claim submitted by seasonal employees whose jobs were ending anyways. Of course, some of these scenarios can be present in legitimate claims, but don't worry, insurers know they're not positive indicators of fraud, just possible ones and warning signs that they should further investigate that claim. Let's look at personal injury mills. One of the more popular insurance frauds involves crashes that result in both legitimate and fake or exaggerated injuries. The fraud has many nuances and variations. When this fraud occurs, the same characters seem to appear. Certain medical providers or lawyers seem to perform the same service, or actually fraud, over and over again. If insurers notice a particular provider submitting numerous claims over time for accident victims that coincidentally receive a similar treatment regime, that's a big red flag. Let's look at data analytical and artificial intelligence that insurance companies have. They've got complex computer algorithms, which really just mean math problems or math equations that have been developed to target suspicious invoices and invoice patterns, be it from physicians or medical establishments. Invoicing fraud is not restricted to medical claims. Auto repairs is another insurance category rampant with invoice and billing fraud. Coming up, I'm going to tell you a few more things that insurance companies are looking for. You need to stay tuned. We work with both insurance companies and insureds that may be dealing with investigating and quantifying a claim, defending an insurance denial, or recovering losses for clients affected by fraud. The insurance company is armed with expertise, and the insured is likewise entitled to engage its advisors and claim preparer to ensure it receives full indemnity on insured losses. Where a claim is complex or contentious, the skills of a forensic accountant can be and will be invaluable to the measurement and substantiation of the losses incurred. An experienced forensic accountant brings three critical skills to an insurance claim: an understanding of insurance contracts and their application, sound accounting and financial analysis, and the ability to present findings, financial evidence, and opinions to a court standard. If this video has been helpful to you so far, please don't forget to like below and subscribe to my YouTube channel. To find out more about me and the services we offer, please visit uncoverfraud.com. So welcome back, and now let's talk a bit about the Special Investigation Unit. Many insurers have Special Investigation Units, or SIUs. Employees who work in SIUs generally have backgrounds as detectives, police officers, medical personnel, and the like. They are capable of performing a variety of tests and checks to see if anyone is trying to commit fraud. Also, employee background checks are done. Insurance fraud isn't limited to external sources. There's a certain amount of it that originates within an insurance company or the insurance company's staff. Claim adjusters cut a lot of checks, and unethical folks may try to skim a few bucks off the top. Agents can commit fraud by stealing customers' car insurance or life insurance premiums. What the agent does is they take in the customer's money, they pocket it, and they never actually purchase the policies. Savvy insurance companies try to prevent such fraud by running background checks on all prospective employees. Applications from those with bad backgrounds are flagged as those more likely to commit fraud. Social media. Much like forensic accounting and fraud investigators, insurers use social media to check up on suspicious claims. Perhaps the claimant who said his car suffered hail damage will be bragging about his deception on Facebook or Twitter, or will upload a video on YouTube showing how to create hail dents in your car's hood. Who would be that stupid? Luckily for insurance companies, plenty of people. Social media's most significant application in claims fraud, though, is in disability cases. A quick look at a claimant's Facebook photos and postings often makes it clear whether the person is genuinely disabled. In the past, I've seen somebody who's claimed for back problems only to be recorded at a bingo hall, jumping up and down when they won bingo, not once that evening, but 3 times. A hat trick in some cases, but definitely a downfall for the insurance claim. Also, insurance companies cross-check and cluster. One of the easiest ways for insurers to catch crooks is via a basic cross-check. All this involves is looking for simple patterns in the checks they're sending out to pay claims. If the same person is receiving numerous reviews, that is a warning sign. So is the payment of several big claims to the same address, even if the name on the check is different. It's not rocket science, but it works. Insurance fraud costs everyone higher insurance premiums. Not only that, but it is an offense under the Federal Criminal Code for anyone, by deceit, falsehood, or other dishonest act, to defraud or to attempt to defraud an insurance company. If you are caught committing or attempting to commit insurance fraud, your claim will be denied, your insurance policy may be canceled, you may pay higher premiums in the future, you may be denied insurance in the future, and more importantly, the offense is punishable by a maximum of 14 years imprisonment for cases involving an amount over $5,000 or otherwise a maximum of 2 years imprisonment. You might not recognize some activities as insurance fraud, but the list that I'm going to go over gives you examples of some common types of fraud. Participating in or organizing staged auto collisions. Lying about the way a loss occurred. Filing fraudulent losses or damage claims, including previously existing damage or loss to a claim for a new damage. Like a car that may have had 4 dents on it, now it has a new dent from an accident, and suddenly the insured believes they can get it all fixed. Conspiring with healthcare providers to receive payments for health treatments not received or warranted. Presenting or filing a false and misleading document or information. With all red flag warnings and the risk of getting caught, it's surprising that an insured is willing to take the risk. My name is David Malamed, and I am a forensic accounting and fraud investigation expert. To learn more about me and the services we offer, please visit uncoverfraud.com. Hopefully you found this video helpful. If you did, don't forget to like below and subscribe. God bless and see you next time.